I mean, look, I think there's a framework, but the reality is that there's mass uncertainty. And I think you could still have 10 to 15% CapEx large purchases that ultimately significantly get downsized or at least get paused. And I think that's the issue here. I think tech is going to be very volatile going into earnings season. I think a lot of these companies either don't give guidance or give very general guidance. And I think that's just the reality of what's happened. You've set a storm in motion. We came off the cliff, no doubt, very positive for big tech. But we're still, I think, only a quarter way through this.
Dan Ives opens with a reality check. While some believe a constructive framework is beginning to take shape, uncertainty still looms large over the tech landscape. Capital spending isn't just slowing, it's being slashed. In this environment, volatility is the only constant as we head into earnings season.
Well, I mean, absolutely. A lot of these stocks are still well off their 52-week highs. What do you make of the rally yesterday and the pullback today? Nothing really fundamentally changed from yesterday. Why do you think we're seeing such a sharp pullback today? We're looking at Nvidia shares down more than 3.5%, Microsoft pulling back about 1.5%. We're going to get to your Microsoft call in just a minute.
It's like being in a storm, and then you come out in a hurricane or a tornado, and you come out, what's the damage? The damage is real. I mean, uncertainty. I mean, we talk to so many out there in the field, in the U.S., in Europe, across Asia. And I think the reality is, like, this has created a lot of uncertainty for the tech world. But China is the hearts and lungs of the tech world. And those tariffs are going to continue to increase. And I think that's the worry here, is that you're playing with a third rail issue when it comes to China. And that's what, from Apple to Nvidia and the rest
Despite
of
deep uncertainty, Ives isn't sounding the alarm. He's reaching for the pandemic playbook. The June quarter is a mulligan, he says, and long-term investors will be watching for signs of a U.S.-China de-escalation. If that happens, today's pain might set the stage for tomorrow's winners.
All right, let's get to your Microsoft call. You lowered Microsoft's price target from $550 down to $475. Part of your thesis is that tech spending, CapEx spending related to data centers and everything is pulled back 10 to 15%, and you're saying that's conservative. Why? I mean, the tariffs, if we're being fair, and Brad Gerstner pointed this out, they've only been in place for about a week, maybe 10 days, and we had some insight they were going to come. What has fundamentally changed so much that you think spending is going to pull back 10 to 15%?
CapEx plans are paused. I mean, from a large
But why don't they just restart? Isn't that the whole thing?
Because ultimately, it's like once you start that snowball, you can't just stop it. And when you look at it, it's still paused, but then it all comes down to China. China is the epicenter. How many companies are exposed to China? On the tech side, it was from when you think about shipping, what's coming in, parts. If a CIO ordered something, it's $100,000. Is now they paying another 100? Is it going to be double? So I think that's part of the issue. When it comes to Microsoft, and you'll see this with Google, you'll see with Amazon in terms of hyperscaler spending, I think it's paused a lot of what we're seeing.
Well, let me push back on you. You're saying it's paused, and you're saying it's primarily because of the China tariffs that, again, have jumped up to 125% right now. But if there's a deal made with China, the president seems to be very confident that he can make a deal. Does that change the whole outlook? Does that go back to boosting CapEx spending? And then how do the sector tariffs and the metals tariffs, how do those impact that?
Yeah, it's a great question. Well, first off, I think at this point, Street's going to look at June quarter is basically a mulligan. In other words, June quarter is going to be very, very soft. And I think investors will look to any sort of sign of a China deal and a de-escalation. To your point, the reason we haven't downgraded one tech stock, we've lowered target, is because, in my view, it's going to be the COVID playbook. You throw out 2-3 quarters, you look at 26 earnings, and you look at a worst best case, and that's the way that you pick the valuation of the winners.
Let me ask you something that I'm sure you're at least beginning to think about. So a lot of these big-time tech CEOs, they were at the inauguration. They've been going to meet with the president, and the president's been very proud to say that they're going to increase their spending, like Apple increasing its spending here in the U.S. If they pull back, does that raise the risk of them drawing like the ire of the president and maybe an administration that's not so friendly?
Of course, because the reality is all those projects that you're talking about in terms of Stargate and everything else and some of the app projects, how are you building that? Where is it coming from in terms of the products? I mean, it comes down, China is the epicenter. So it comes down, the unintended consequences here are key. And look, big tech, they're caught in the middle. And I think they are still trying to get their grasp. Apple's not flying 4 airplanes of iPhones if they felt that they were ahead of the game. It's a game of high-stakes poker, tech caught in the middle.
All right, we're going to go back to your call today. You're moving your price target on Microsoft from 550 down to 475. You think tech spending overall declines by 10, maybe 15%?
I think street numbers right now, you're assuming really across the board, you're going to see earnings cuts of about 10% across internet, across big tech. And I think anything worse, that's why you'll see a lot of volatility. Buckle the seatbelts going into this earnings season.
At the heart of this storm is China, still the epicenter of global tech supply chains. Tariffs aren't just pressuring margins, they're triggering real-time decisions to pause or cancel major projects. Ives compares it to a snowball in motion. Once it starts, it's hard to stop.